Hello and welcome to this session. This session we're going to talk about risk and return. I am your lecturer Natalia Francois. Now, in most important business decisions, there are two key financial considerations. Basically, risk and return. Now, each financial decision presents certain risk and return. Every financial decision that you make have some kind of characteristics, and the combination of these characteristics can increase or decrease the firm's share price. Analysis use different methods of quantifying this risk depending on whether they are looking at a single asset or a portfolio, a collection or group of assets. So they want to examine um, an investment opportunity into a certain asset. So maybe it's a stock, right? What's the risk involved in that stock? Or they may look at a portfolio in a whole. They have different investments in different companies, different stocks. How do you analyze this portfolio to determine what's your risk and return? Since they are in everything and they're involved in every investment decision that one person makes. Now, risk is a measure of uncertainty surrounding, take note of that, it's a measure of uncertainty surrounding the return that an investment will earn. So we've calculated returns, right? We know a return 10%, 12% expected return. But what's the risk around that return, right? How would it vary from the return? Return now is the total gain or loss experienced on an investment over a given period of time, calculated by dividing the firm's cash distributions, so let's say it's dividends, during the period plus any change in the value. Change in the value will be the beginning price minus the ending price, divided by the beginning of the period price, beginning price. So I like to call it holding period return, HPR. HPR is the dividends that was paid plus the beginning price minus the ending price divided by the beginning price will give us the return, right? The return. Now this text have another formula. Here we'd see it. It represents same thing. So CT will represent the cash flow. In this case, a stock we'll call it dividends, right? That's the cash flow from the investment. RT, well, is the rate of return that we're looking for. The price of the asset at time beginning minus the price of the asset, and minus the beginning, right? Let's look at an example. Robin wishes to determine the return on the two stocks she owned in 2012. So again is the return. What return did she get from two stocks that she owned? At the beginning of the year, the Apple stock traded for 411.23. So we know already, right? Let's put our formula. So the cash flow plus the ending price minus the beginning price, all divided by the beginning price. And let's substitute one time. So at the beginning of the year, we have the beginning price, and Walmart beginning price was $60.33. During the year, Apple paid dividends of $5.30. So we have the dividend and Walmart shareholders received dividend of $1.59. At the end of the year, Apple stock was worth 532.17 ending price, and Walmart sold for 68.23 ending price. Right, so here we have it, all divided by beginning price. So the return she got from holding Apple stock, 30%. So it simply means she purchased it, let's say she purchased it for $411. At the end of the year, it was 532, right? So there's a difference. And then she had $5.30 on her stock. Divide her beginning price, her return is 30.7%, right? And for Walmart, it's 15.7%. So that's the value of the return. Here we have some historical returns on selected investments during this period. Right, so just a history, showing the nominal and real return of treasury bills, treasury bonds, and common stock. And we could see stock had a high return of 6.2 in those times. Nice. So economists use three categories to describe how investors respond to risk. So an investor is risk averse when the attitude towards risk in which they require an increased return as compensation for an increase in risk. So they are adverse if they believe they're taking on more risk, they want more return. Risk neutral now is the attitude towards risk in which investors choose the investment with a higher return regardless of the risk. Right? They just want a higher return regardless of the risk. Risk seeking is the attitude towards risk in which investors prefer investment with greater risk, even if they have lower expected. So the risk seeking, they're looking at risk. Right? The neutral, they don't care about the risk, they want the return. The adverse, they want to make sure they get the money that they're taking on, whatever risk they're taking on. So we want to analyze these risks. Right? This is part of finance, analyzing risk. Doing a risk assessment of a single asset. So let's say it's a Walmart stock or Apple stock. What we do is what they call a scenario analysis, right? To identify or analyze this risk for the single asset. The scenario analysis is an approach for assessing risk that uses several possible alternative outcomes called scenarios to obtain a sense of the variability among returns. So how much will it vary from the return? So sometimes we say what's the worst thing could happen, what was the most likely thing to happen, and what's the best of things could happen. So the range is the measure of the asset risk, which is found by subtracting the return associated with the worst outcome from the return associated with the best outcome. So this scenario is going to tell us what's that expected return. If we have a worst condition, if we have a most likely condition, and if we have a best condition. When we're done, now we want to find the range. What's the range between this expected return and the worst condition or the best condition, right? What's the expected return we get? What's the likelihood that it will be worse or that it will be better? Through an example, Norman Company wants to choose the better of two investments, A and B. So here he sees this investment. Let's say he's making an initial investment of 10,000 each. The most likely return is 15%. More than likely, you're going to get 15% for each one of them. The management has associated the return with asset A, which appears to be riskier than asset B. The risk-averse decision maker would prefer asset A over B. Why? Because they want to make sure that they get a return for the risk involved. And A offers the same most likely return but a lower risk. So most likely it will be 15%. In the worst case scenario, it might be 17%, 20%. Best scenario, worst scenario is 13%, 7%. Best scenario it might be 17 and 23 range. Now stay with me, so we're going to perform an analysis, right? Assessment. So Norman Company past estimate indicate that the probabilities of the pessimistic, most likely and optimistic outcomes are 25%, 50%, and 25%, respectively. So there's a 25% chance that the assets will give a return of 13%, right? And then there's a 50% that it will be at 15% and so forth. Note that the sum of the probabilities must be equal to 0. So if you add 25, 50, and 25, we get 100. Right? So your probabilities must equal to 0. A bar chart is normally used to depict this estimation. So let's look at asset A. We said it's most likely 15%, less likely 13, most likely 17, and asset B, C, less likely 5. So we see the variance between them, or range. The probability distribution curve also demonstrates, I guess this should also be asset A and asset B. So if we look at the return, it should be 15%, 15%. If asset A, the distribution is closer, right? The range is smaller than asset B, which is more dispersed. Watching this graph will tell me, right, if I'm interpreting this graph, that asset B is more risky. Why? Because it varies, it deviates far from the expected, what I will call statistics mean, right? The expected return or the mean. Now, standard deviation, you've heard of the term before, is the most common statistical indicator of asset risk. It measures the dispersion around the expected value. So in that graph I showed you, see how it's dispersed from the expected. The expected should be 15. How it's dispersed, right? So the standard deviation will tell you how much is dispersed or far from the expected mean. Expected value of return is the average return that an investment is expected to produce over time. And we find it by multiplying the probability of the occurrence by the number of outcomes considered. So let's look at this example again. Asset A, we have pessimistic, most likely optimistic. We said there was 25% likely, it's going to be 13% expected return, right? So these are given to us, 50%, 15%, 25%, 17%. Right? Probability is always equal to 1. So we are given this. We are given these values. Now let's find the expected return, as we said, which is the sum of all the likely outcomes. So we're doing the scenario analysis. Stay with me. So how do we find the expected return? We multiply the probability by the returns. Okay, this is what the formula is saying here, right? And then we sum it. Multiply the probability by the returns and we sum it. So 25% by 13% give you 3.25, and so forth. Then we sum it. So we sum all the expected return of each scenario. So we get an average expected return of 15%, right? Which is what we saw. For B as well, we have all the scenarios, the likelihood of them, and the percentage return if it does happen, right? We multiply again by each one. So the expected return is also 15% for asset B. Right, so we have the expected return. Let's find the standard deviation or the range to see how varied it might be from this expected mean of 15%. So standard deviation is normally the square root of what we just found there, right? We're going to find the range. So we have the mean, we call the expected mean or return. We're going to find the range by multiplying it by the probability minus the probability multiplied the expected return by the probability, squaring the expected return and minusing it from the probability, and then finding the square roots to find the standard deviation. So here we have asset A, right? And we have in the pessimistic, likely, and optimistic. These are our figures, right? Most and optimistic. These were our returns, right? 13% likely, 15% likely, 17% likely. The expected return, so this is the expected return, which we just calculated by finding the average, is 15% for each area. We minus the probability return from the expected return, we get -2. We get 0, we get 2. Our next step is to square this, right? You want to square this to get the range. You want to find out what's the range. So we square it, we get 4%, square 0, 2%, square 2, we get 4. Now our probability says the pessimistic is 25%, 50% most likely, 25% optimistic. What we do, we multiply it. So we multiply 4.5% by 0.25 and we get 1%. We get 1.1%. 0 multiplied by 0.5 or 0 multiplied by everything is 0. 4 multiplied by 2.5. Right, so we get in this 4% by squaring this, right? Times the probability is 1. When we sum it, we get 2%, right? This is how we get 2% using the formula. This is the range. When we're done, we find the square root of the range to get the standard deviation. That's the standard deviation symbol. We get 1.41%. Now that's asset A. So asset A, this is the standard deviation. Let's look at it for asset B. asset B, the expected return again was 15% for each scenario, which is the pessimistic, the most likely, and the optimistic, right? 7, 15, 23. Now these figures were given to us, so we want to find the expected mean. We want to sum it up, the expected mean of all these scenarios, and minus it from the probability. Right, so 7 minus 15, negative 8. Right, then we're going to square this. We got 64. We're going to get a range. 15 minus 15 is 0. We're going to square this. We're going to get 0. 23 minus 15, we get 8. We're going to square this and we get 64%. Then now we're going to multiply it by the probability. 25%, right? 0, 16. When you sum it, you should get 32. 16 and 16 is 32. Find the square root of 32, 5.6. Now which one is higher? Asset A is 1.4. Asset B is 5.6. So this demonstrates or tells us that asset B is most risky. But do you realize that they give the same return? Each one is given the same return. But asset B, so when I say return, expected return, remember when we calculated expected return? For A, we got 15%, and for B, we got 15%. But when we're doing a risk, A is 1.73 and B is 5.63. So if you have to invest in one of these assets, giving you the same return, which risk would you take? You know, the risk averse person will take, I'll take less risk, right, for the 15%. Now, the coefficient of the variation. The coefficient of the variation is a measure of relative dispersion that is useful in comparing the risk of assets with different expected returns. Right? So the last one we had the same returns. So the coefficient now will, coefficient of variation will help us to determine the risk of the asset with different expected returns. And it's found by the standard deviation divided by the expected return. And it's good to note here, a higher coefficient of variation means that the investment has more volatility relative to expected return. I mean, the higher it is, the more it's further away from what is expected. So it's very risky that you won't get that expected return. Using the standard deviation from table 8.6 and the expected return from table 8.3 for assets A and B, we calculate the coefficient of the variation. So we saw, or we found, the standard deviation for asset A and asset B was 1.4 and 5.6, and we also found the expected return was 15% for each one, right? So now the coefficient of the variation is 0.094 and 0.37. So going back, it tells us the higher the coefficient of variation means that the investment has more volatility relative to its expected return. It's more volatile. Now, risk of a portfolio of investment. In a real-world situation, the risk of any single investment would not be viewed independently of other assets. So you may have other assets in your portfolio, right? How diversified it is, what risk is involved. New investment must be considered in light of their impact on the risk and return of an investment portfolio of assets. The financial manager's goal is to create an efficient portfolio, a portfolio that maximum return for a given level of risk. the return on the portfolio is measured using the weighted average of the returns of an individual asset from which it is formed. So here the formula we have the weighted average of the first year times the rate of return plus the weighted average of the second year times the rate of return of the second year, and straight through until the number of years the asset is being held for. For example, James purchases 100 shares of Walmart at a price of $55 per share. So he has 100 shares, $55 per share. How much is his shares? $5,500, right? He also buys 100 shares at Cisco for $25. So how much is his shares? That's 100 by 25, 2005. Combining these two holdings, James' total portfolio is now worth 8,000. That's 5,555 plus 25. Of the total, 68% is invested in Walmart. That is 55 divided by 8,000, and 3125 is invested in Cisco. That's 25 divided by 8. Thus, the weighted average cost, as we said, was 68 and 31. So when we add them up, we get 1, right? So let's calculate the expected return on this portfolio. He has two stocks. Stock A and stock B. Well, we call it asset X and asset Y. So in 2014, these were the forecasted return. 14 to 18, we have asset A and X and asset Y. To calculate the expected return on the portfolio over those years, we multiply it by the portion that is invested. So 50%. I think I missed a slide. Okay. The example assume 50% is invested in each asset, right? So it's 50% by the rate of return. So W1 by rate of return, W2 by rate of return, like for stock XY. When we add them together, we get 12%. So 50 by 10, 50 by 14, add them, 12%, and so forth. To get the expected return mean, we sum it and divide it by the number of returns. 5 returns, 1, 2, 3, 4, 5, 5 years, 5. Each is 12, so 60% divided by 5 give us 12%. So the return on this portfolio is 12% using the weighted average cost. Now, how do we find the risk? Same standard deviation. So what we do here, same thing. We take the expected mean minus the weighted average mean, right? And we square it. Well, 12 minus 12 is 0, divided by 4 is 0. So this portfolio has no risk, 0 risk. Standard deviation is 0. Then we have how it correlates. Risk of a portfolio correlation. So we learned how it varied, and we learned the risk, how far it varied from the expected mean. Now the correlation is the statistical measure of the relationship between two series of numbers. Positively correlated describes two series that move in the same direction. Negatively correlated describes two series that move in opposite direction. So a perfectly positive correlation describes two positively correlated series have a correlation coefficient of +1 and negative has -1. So just looking at the graph can tell us how it's correlated. So perfectly correlated, the two stocks are going in the same direction. When they are not going in the same direction, they can have a negative correlation. What all this means? To reduce the overall risk, it is best to diversify by combining or adding to the portfolio assets that have the lowest possible correlation. So combining assets that have a low correlation with each other can reduce the overall variability of the portfolio returns. Remember we discussed this variability, the variance. We want to make it close to the mean as possible. Don't want it spread out far and wide. So uncorrelated describes two series that lack any interaction and therefore have a correlation coefficient close to 0. So here we have two assets, F and G. What you see here, they're moving in the same direction but at different times, right? But it brings them closer. When you put the portfolio together, you bring them closer to the mean, right? And so this is a pretty diversified and safe portfolio. So we have assets X, Y, and Z over a 5-year period. Looking at it, let's see if we put them together, what type of risk is involved. So the portfolio creating two stocks, XY, so this one represents XY, and this one represents XZ. So X and Y or X and Z. 50-50. Let's say we take 50-50 of each one, right? You get 12%. 12%. We did that in the last example. Standard deviation, we square the mean, and so the portfolio for X and Y, the standard deviation is 0. While if they take X and Z stock, the standard deviation is 3.16. So you might well as take X and Y because it carries the same expected mean but less or no risk. The inclusion of assets from countries within business cycles that are not highly correlated within the US business cycles reduces the portfolio responsiveness to market movements. So while the US might have some challenges because of economic forces, if you invest internationally, you can help diversify your portfolio and minimize your risk, right? Over long periods, internationally diversified portfolios tend to perform better, meaning that you get higher returns. However, over shorter periods, such as a year or two, internationally diversified portfolios may perform better or worse than domestic portfolios, because I guess they have less time. Currency risk and political risk are unique to international investing. So especially if you're looking to invest in Forex, trading, and Bitcoin and any foreign investments, you are exposed to currency and political risk. Now there's another model we use to identify risk. I like this model. It's called the CAPAM, right? Capital Asset Pricing Model. CAPAM is a basic theory that links risk and returns to all assets. The CAPAM quantifies the relationship between risk and return. So while before we had to find expected mean and standard deviation, the CAPAM puts everything together and tells us you know, what's the relationship between the risk and the return of a stock or portfolio. In other words, it measures how additional return an investor should expect from taking on extra little risk. Let's define some terms. Total risk is a combination of the firm's non-diversifiable risk and diversifiable risk. So we need to differentiate those, right? So the CAPAM takes into consideration non-diversified risk and diversifiable risk. The diversifiable risk is the portion of the asset's risk that is attributed to the firm's specific random causes, right, that can be eliminated through diversification, also called, this is the word I'm looking for, unsystematic risk. So diversified risk are unsystematic, right? It's based on the company and all that's happening there, management and choices that they make. That risk we carry. There's non-diversifiable risk, which has to do with the market forces, and we can't do anything about that. That is called systematic risk. But when we diversify our portfolio, we want to get rid of really the unsystematic risk. Because any investor can create a portfolio of assets that will eliminate virtually all diversifiable risks, the only relevant risk is the non-diversifiable risk. And so from the chart, it's called a security market line. You see, if you look at the expected return, number of securities in the portfolio, and portfolio risk, how far the diversifiable risk is above the return while the non-diversifiable risk is below, right? So this represents the total risk involved. But above the line, we have diversified, and below the line, we have the non-diversifiable risk, which would be, those of a treasury stock. Beta, now you'd have heard beta maybe in statistics or some maths class, is a relative measure of non-diversifiable risk, an index of the degree of movement of an asset's return in response to the change in the market return. An asset historical returns are used in finding the asset's beta coefficient. The beta coefficient for the entire market is always equal to 1. All other betas are viewed in relative to this value. A market return is the rate of the market portfolio of traded securities. So what does that mean? What does that mean? You're looking at the line here, we see different assets, right? S and R. The market return is the vertical line, horizontal is the asset return, and we see how it varies differently. But still, what am I talking about? A company's beta, if it is 1, we're saying is the ideal, it's same response as the market. The rate is the same response as the market. If it's 2, it's twice responsive as the market. If it's less than 1, it's only half. And the same thing, it's negative, it's only half. If it's the same 1, it's moving in a direction. Right? So just think about the timeline. Think about the timeline. You have 0, -1, -2, -3, 1, 2, 3, and you have your curve. It tells you, how far you are from whatever is the beta of 1. So the beta of a portfolio can be estimated by using the betas of individual assets it includes. Letting WJ represent the portion of the portfolio's total dollar value represented by asset J, and letting BJ equal beta of asset J. We can use the following equation to find a portfolio beta. So when you sum all that up, We're supposed to get the sum of the portfolio dollar value times the beta. Example: Mario Ostino, an individual investor, wishes to assess the risk of two small portions he's considering. Portfolios, sorry. He is considering W and V, V and W. So under portfolio B, asset 1, 2, 3, 4, 5, right? These are the different betas to them. And this is the proportion he's holding. 10% in asset 1, 30% in asset 2, 20% in asset 3, 20% in asset 4, and this set. So maybe we can call this some mutual fund, ETF, shares, right? It's a whole portfolio, right? So these are the assets, meaning the different things he have invested in, and this is the portion of his investment, and these are the beta for the companies. B, portfolio B, this is the proportion of investments, right? So asset 1, he has 10%, asset 2, he has 10%, asset 3, 20%, asset 4, 10%, and asset 5, 50%. Right? So 50% of his portfolio in W is for asset 5. And these are the company's beta for these investments. Next. The beta for the two portfolios now, BV and BW, can be calculated as follows. We're multiplying each asset by its beta and we're summing it. Right? That's what the equation says. So for asset 1, asset 2, asset 3, 4, and 5, we multiply the portion by the beta, we sum it, the beta is 1.2. For asset W, the beta is 0.91. Which one you think is closer to 1? Using the coefficient to measure non-diversifiable risk, right, because we're concerned about that part of the risk, the capital asset pricing model is given the following equation. So RJ is the required return using the kappa model. RF is the risk-free rate of return commonly measured by the whatever is the US Treasury bill rate. We call that risk-free. Right? That is the diversifiable, that's the undiversifiable, that is the diversifiable risk. BJ is the beta, RM is the market rate minus the risk-free rate. So that's the formula for kappa. As I said, I like using this formula because it's very much simple. The kappa can be divided into two parts. The risk-free rate, as we said, is the US Treasury bill. We have the beta, and then we have the risk premium. And the risk premium is the market premium minus the risk-free premium. The market premium minus the risk-free premium. That's historical stats. So let's look at this example. Benjamin Corporation, a growing computer software developer, wishes to determine the required rate of return on asset Z, which has a beta of 1.5. The risk-free rate of return is 7%. The return on the market portfolio asset is 11%. So now we substitute using the kappa model. So here we have the risk-free rate is 7% plus the beta times the market rate times the RM, the market rate minus the risk-free rate, right? So it gives us 13%. See, super simple. Now you have this SML line. It's a depiction of the capital assets model. It's really a graph that is used to measure the beta by plotting the beta on the x-axis and the return on the y-axis. So it simply shows us the risk-free rate, as we saw, is 7%. We plot on this line. At a beta of, market rate is 1, beta should be 1, right? So if we go up and we go across, this is our first line. Oh, sorry, I'm so crooked. We should find the next line. We should find is the market rate, which is 11%, and the market beta, oh my gosh, right? So we have 0.1 here, we have 0.1 here, and then we just found CAPAM 13, so we plug that in, and the beta for 13 is 1.5. So we end up at this point. Connect the dots. This is our SML line. So should you have to plot it, right? You plot the risk-free rate at market beta, the market rate at market beta, CAPAM at the company's beta, and you connect the dots. CAPAM really relies on historical data, which means the betas may or may not actually reflect the future variability of returns, right? So it's based on history. So the model should only be used for approximation. CAPAM assumes markets are very efficient. And that's the end. See you in the next session.